Hi, I'm Harsh, and today me and my group members will provide a detailed report on special purpose acquisition companies, also known as SPACs. First, let's understand what a SPAC is and how it works. A SPAC is a very hot topic on Wall Street nowadays. They are not the typical companies that we are aware of because they work in a very unconventional method. A special purpose acquisition company is a corporation formed for the sole purpose of raising capital through the issuance of an IPO. Such a business structure allows investors to contribute money towards a fund, which is then used to acquire one or more unspecified businesses after the IPO. Therefore, this sort of shell firm structure is also known as blank check company in the popular media. When the SPAC raises the acquired funds through the IPO, the money is held in a trust until a predetermined period elapses or the desired acquisition is made. In the event that the planned acquisition is not made or legal formalities are still pending, the SPAC is required to return the funds to the investor after deducting the bank and broker fees. So now let's see how a SPAC works. A special purpose acquisition company is formed by experienced business executives who are confident that their reputation and experience will help them identify a profitable company to acquire. Since the SPAC is a shell company, the founders become the selling point when sourcing the funds from investors. When issuing the IPO, the management team of the SPAC contracts an investment bank to handle the IPO. The investment bank and the management team of the company agree on a fee to be charged for the service, which is usually about 10% of the IPO proceeds. The securities sold during an IPO are offered at a unit price, which represents one or more share of common stock. After the SPAC has raised the funds through the IPO, the management team has 18 to 24 months to identify a target and complete the acquisition. The period may vary depending on the company and the industry. The fair market value of the target company must be 80% or more of the SPAC's trust assets. Once acquired, the founders will profit from their stake in the new company, usually 20% of the common stock, while the investors receive an equity interest according to their capital contribution. Apart from the public units, the units sold to the public comprise a fraction of warrants, which allows the investors to purchase a whole share of a common stock at a specified price. Depending on the bank issuing the IPO and the size of the SPAC, one warrant may be exercisable for a fraction of a share, either one half or a third or two thirds, or a full share of stock. For example, if a price per unit in the IPO is $10, the warrant may be exercisable at $11.5 per share. Now, Vivian will go over the pros and cons of SPACs.
Hi, I'm Vivian, and I'm going to talk about the pros and cons of taking company public through SPACs. The breakout of COVID-19 has led to the failure of many companies taking public through IPO. Hence, more and more companies choose to go public through a special purpose acquisition company. The reason that SPAC has been popular these years is that it does have some advantages in some ways. First of all, the process of SPAC is simpler than IPOs. Going public through an IPO needs an extremely complex process, while SPAC only needs the confirmation of the company acquisition. For the company who would like to go public, choosing SPAC will help the company save both time and costs, improving the speed to the stock market. Under the situation of the COVID-19, a large number of companies' market value dramatically decreased. Hence, the high speed of taking company public through SPAC has a higher certainty than IPO. SPAC is a company which has already been listed before the completion of acquisition. Therefore, to take the company public, it only needs to be acquired by the listed SPAC. so that it greatly reduced the uncertain risk during the process of IPO, such as choosing the securities agency and the fluctuation of the market value of the company. Meanwhile, the company also needs to take the consequences for going public through SPAC. For instance, it doesn't have an advantage on the maximization of company's valuation, as the acquisition price is negotiated between SPAC sponsor and the company. The valuation of the company will be lower than taking it public through IPO. Moreover, the ownership of the initial company will be diluted. The reason for the dilution is that the SPAC sponsor will take 20% of the shares of the acquired company, leading to the original shareholders' proportion of equity being reduced. At the same time, the investor who got the warrants can purchase more shares with the lower price, will also lead to the falling in share price and ownership dilution. Lastly, the company will also face complex accounting and financial requirements. Then, Ho-In is going to talk about the accounting issues about warrants.
So, after discussing the pros and cons of taking companies public through SPACs, let's talk about warrant, which is a common financial instrument for companies to raise funds, and how it is accounted for in a financial report. The generally accepted accounting principle states that businesses must clarify warrant to be as an equity, asset, or liability in the financial report. In most cases, warrant is accounted as equity, since a certain amount of cash is being exchanged to a certain amount of equity when warrant is purchased. And when they meet the two conditions, which are being indexed to the common stock and have met the criteria for equity classification, a warrant is accounted as an equity. However, recently SPACs have evaluated two different fact patterns that would make warrant to be accounted as a liability in a company's financial report instead of an equity. The first fact pattern will be indexation. And with indexation, it will indicate that warrant is not able to be indexed to the entity's stock, since the holder of a warrant is not considered an input into the pricing of a fixed for fixed option on equity share, where a fixed for fixed criterion is when the SPAC could ensure that the money that is received by the warrant holders is remaining the same. Therefore, due to the fact pattern, a warrant should be classified as a liability instead of an equity in a financial report. The second fact pattern is a tender of provision. And why this fact pattern would make warrant a liability is because a tender offer would make all warrant holders to be entitled to receiving cash, where on the other hand, the underlying shareholder are not necessarily receiving cash from this offer. Besides, a tender offer will be out of the company's control, and when an event is out of the entity's control, it cannot be classified as an equity. So, under the circumstances of a tender provision, a warrant would not be considering an equity, so it would be a liability. After knowing how warrant is being accounted in financial reports, let's look at the main accounting issues as identified in the SEC statements.
Thanks, Hong Ying. Hi, I'm Hui Li. I will now present the main accounting issue as identified in SEC's statement. The main accounting issue identified in SEC's statement is that the warrants issued by SPAC should be classified as liabilities measured at fair value instead of equity according to the GAAP's guidance. The liability treatment of warrants complicates the deal and brings additional work and cost for the entity. The first rationale for why treating warrants issued by SPAC as liabilities instead of equity is that these warrants could not be indexed to the SPAC's own stock. So according to the statement, an equity-linked financial instruments must be considered indexed to an entity's own stock in order to qualify for equity classification. The warrants could not be indexed to SPAC's own stock because its provision that could affect the settlement amount are dependent upon the characteristics of the holder of the warrant, which is not an input into the pricing of a fixed-for-fixed option on equity shares. Thus, the warrants are treated as liabilities instead. The second rationale is that the tender offer provision, which was included in the terms of the warrants, fails to correspond to an exception rule to a general principle further included by GAAP. The exception to the general principle whereby equity classification would not be precluded if net cash settlement can only be triggered in circumstances in which the holders of the shares underlying the contract also would receive cash. The terms of warrants include a provision which indicates that in the event of a qualifying cash tender offer, which could be outside the control of the entity, only certain of the holders of the underlying shares of common stock will be entitled to cash. Based on that, the warrants should be classified as liabilities instead of equity. Virtually all SPACs have historically accounted for private and public warrants as equity. According to the SEC's statement, the errors in accounting for warrants described above may affect several physical quarters and years of a registrant's previously filed reports. So in order to adapt to the change, the entity needs further analysis of sufficiency of the internal controls and the related disclosures regarding significant deficiency and material weaknesses. A registrant may correct material errors related to the accounting issues described above by amending its most recent Form 10K and any subsequently forms 10Q. These adaptations to the new treatment of warrants need additional work and resources from the entity. Besides, the liability treatment complicates deals because it requires sponsors to hire third-party accountants and auditors to value the warrants quarterly using a complicated valuation, while equity treatment only requires a simpler valuation. So that's all for my presentation. Now Ling Tong will provide what we think in regards to the concerns raised by the SEC.
Thanks, Li Hui. I'm Ling Tong. Now let me show our views on the SPAC's concerns. The concerns are valid because almost all SPACs have historically accounted for both private and public warrants as equity, and almost all such warrants contain provisions such as those cited in the staff statement. In the staff's view, these provisions would result in such warrants being more appropriately classified as liability rather than equity, and therefore measured at fair value with changes in the fair value of the warrants being reported in earning in each period. This means many SPACs have inappropriately applied equity classification. As a result, the concern may affect most SPACs as well as transactions throughout the life of the SPAC, including formation, SPAC IPO, and so on. Whether current accounting practice should be changed depends on each SPAC's attitude and the view of the statement. If the SPAC believes that the SPAC statement is not material and has not yet filed its Form 10K, the SPAC should reflect the appropriate accounting treatment in its financial statement filed on Form 10K. If the SPAC has filed a Form 10K, the SPAC may reflect the new accounting treatment in its next Form 10Q and update its prior audited financial statement. It is possible that changes in accounting treatment may not be considered qualitatively material because investors are likely to understand the terms of the warrants and the impact of the accounting changes may not affect their investment decisions. On the other hand, if the SPAC places significant weight on the SEC's concern, thereby requiring a restatement of previously issued financial statement, and should amend the filed Form 10K or Form 10Q. While the SEC identified two specific issues in its statement, it reiterated that the accounting assessment of warrants issued by SPACs requires careful consideration of the specific fact and circumstance of each entity and each contract. The company has been working with their valuation and financial reporting consultants to assess the impact on their historical financial statement and to determine if a restatement is required.
Thank you for listening.